buddy.
Great to be with
you. Thank you. All right. Nuria, she's amazing, isn't she? My gosh. Her energy just radiates all over the stage. So great job, Nuria. You were amazing. Michael, it's an honor to have you with us.
Gary, it's great to be here. Thank you for the invitation.
Oh, always. For those of you that don't know, Michael is the CEO of Freddie Mac. And if you're not in the lending business, I'll just tell you this. He's one of the most powerful and influential people in the entire industry. So it's great to have you with us today, Michael.
Pleasure.
So let's have a chat. Obviously, the market is going through some changes right now. Interest rates are higher. Let me just start off by asking you, how do you see the market sort of progressing over the next 12 to 24 months?
Yeah, I think, there's no question we've gone through a change in the marketplace, and everybody's adapting to that change. But let's think about what we know. We know that the economy's still growing, right? It's maybe growing a little slower than it was more recently, but it's still growing. The labor market's still strong, maybe not as strong as it once was. We have this huge group of millennials, many of whom are Latino, who are eager to become homeowners. And that demand is bigger than the supply of homes in the country.
That's right.
At the moment.
Yep.
And so what's really happening in the real estate market is a classic macroeconomic, like the most basic economic activity there is. Demand is greater than supply and home prices are drifting higher, which is kind of amazing given how much rates have moved. But it's, there's other factors too. Institutional buyers are not as active in the market as they once were, which is freeing up some supply for first-time home buyers. And so there's reasons to be optimistic, but it is different than what we've experienced in the last decade, or maybe even a little longer. You and I are maybe old enough to remember when 7% mortgages were really
awesome.
Sounded fantastic, right? I mean, it would be amazing if you could get to 7%, and today it's sort of a barrier in the marketplace. So it's a little bit psychological today.
Yeah, I think it is. And, there are some additional, I don't want to say, benefits, but rising interest rates has driven out a lot of the competition in the market. There's a lot of people out here that work with a lot of first-time home buyers who've had to compete with institutions for a lot of those properties. Those folks have left the market altogether. So that's a positive. The inventory thing, I think, is not something that's going to be solved easily. It's going to take time to address that.
Right.
That supply and demand issue has been out of balance for the last decade, really. So hopefully we'll see that improve. Am I going in and out with the mic?
Yes, okay. Fix your microphone.
All right. Great. Thank you. I'll go with this now. So, I look at things from a very pragmatic standpoint. People talk about the Hispanic market from a number of different perspectives. It is where the growth is. It is the future of our industry. One of the taglines we use downstairs is, this is the new mainstream in America. And it's here to stay, essentially. But in order to see the numbers and the people who want to participate in home ownership continue, I think there's some tweaks we have to make to the industry. One, we need to create more diversity in the industry. Yep. We need more people who come from the communities who can help navigate people through the process. But I've always felt that there's a misalignment sometimes around incentives, right? So if you are a mortgage lender, and we've got a lot of mortgage lenders in the audience, raise your hand. You guys are in the mortgage business. There we go. Sometimes it's a little tougher to qualify first-time home buyers, Latino home buyers. Sometimes there's not as much money to be made from those deals. And a lot of times they're more labor intensive and so forth. So I really like to talk to people like you about how we can better align some of those incentives. I know it's not easy, but I know there has to be a solution out there.
Well, I think there's ways to make lending easier. And it requires us to think more broadly. So, I'll give you an example, and I'll put a plug in for Freddie Mac here. So we've released some new tools to the market, to lenders in the market, and if you're not using them, talk to our team who's here on site, or go back to your leadership team and say, why aren't we using Freddie Mac's tools? But think about the things that are harder to do, right? Which are understand the credit profile. We know that. We know that the credit profile for people who are newer to this country just isn't as long. It's not as deep. So we have to be able to look through the score and see more of what's really happening in that family's household in terms of understanding that. We also have to understand capacity differently. We talk a lot about income. I know you like to talk about capacity. I do too.
Yep.
And so we have to be able to look through and see what's really happening in that household economy. What's happening at the kitchen table in terms of where the bills are getting paid and how the money is flowing. And you can see that if you can see people's bank account. Okay? If you can see people's primary bank account, you can see where people's money is going. And so we've released tools, one we call AIM, Asset Income Modeler, and if you connect to it through your loan origination system, through to our loan purchase engine, we can look at that and recognize when there's a pattern of savings going on, when there's a pattern of rent being paid. And all those things contribute to our confidence in the ability to buy loans and make it easier for all of you to originate them. So, and originate them with confidence. So I think that, we're gonna keep working on things like that. What we know is that today's economy is not the economy of the 1960s and 1970s, where the majority of households came home with a W-2. We know that, you often refer to it as the gig economy, right, which I think is a good way to describe it. And so we know that that exists, and we have to be able to see it so we can understand it and assess capacity effectively, help lenders do their job with confidence, help them sell loans to us with confidence, and help grow the market.
Yeah, I love that. Let me kind of frame what you just said a little bit differently, because I think it's one of the most important points that you and I had the chance to talk about backstage before we got started. So I've been in this business long enough to remember a time before credit scores.
Sure.
And underwriters would look at credit files and they would make a judgment. This person made their Sears account payment on time. They have one credit card. They have, a mortgage in the past. And they would use human judgment to make an assessment about credit. And then credit scores came. And a lot of us were skeptical about that, right? So this was gonna standardize credit evaluation, and they were gonna somehow consolidate it into an actual number, and we're supposed to base our underwriting criteria on that number. All right, so it's not a perfect process, but it's here to stay, and it's proven to be an actual sort of, I think, benefit to the marketplace in terms of efficiency. But to your point, when it comes to evaluating capacity, debt to income ratios, which is the old terminology, we use pretty much the same process for that. And I've always thought, why isn't there some sort of equivalent of credit scoring where we can look at capacity? And to your point, we live in a different economy today. It is a gig economy. And I like to joke that Latinos actually invented the gig economy about 40 years ago, right? Because we've always done whatever we need to do to get done and to take care of our families and to support one another. Always done that. But now that's standard, right?
Yeah.
So we can't just look at the income profiles the same we did in the past. We have to use tools like what you just described. We have to start looking at different metrics if we're going to qualify people today and in the future, to your point.
Yeah, I think we have to learn from them, right? So we have to continuously be in a learning mode, which is one of the things we've been working on at Freddie Mac, which is to say, okay, we understand this well, but what more can we learn, and how can we apply our new learnings differently? And so we have to think of this as an ever-evolving, ever-changing, ever-learning loop. And part of that means we've got to adopt tools, gather data, learn from the data. It helps us understand how to do it differently.
Do we see a time when it'll be as easy to qualify for a mortgage as it is, for example, a car loan? Right? I mean, I've always sort of questioned that in my mind. You go in and you buy a car and you have a $40,000, loan against that, and you drive off with the car that day.
Yeah, it drives away.
Exactly.
By the way. Yeah, it's hard to find.
And it is a it is a more risky loan than a home loan, which is an actual appreciating product versus a depreciating asset per se. So why can't we get a mortgage that way today? And what can we expect in the coming years?
Well, I think to approach that it helps to break it down into its pieces.
Okay.
Okay? So let's start with the property. So how well do we understand the value of the property? For many, many properties in America, we understand it really well, right? Even in times when trends are moving in one direction or another, we have a pretty good view because it's not that unique. So the number of really unique properties in this country is not that many. The majority of homes in this country look like the one next door and the one next to that, and are pretty similar, and maybe there's some conditions. So property valuation is going to get faster, it's going to get better, it's going to get smarter, and I think we have to continue to work at that. The second piece is around credit and capacity, and we just talked about those. So scores help, and I, like you, remember when there wasn't a score, and when we looked at trade line by trade line on the bureau to decide whether or not we were going to make a loan. And now we have a score, plus we have the ability to use technology to look at those trade lines and help us understand what's really going on underneath the surface. And so I think that's going to continue to evolve. And then, you know, we talk about the gig economy, but in reality, every household's economy is different, right? Every family unit's household structure in terms of income coming in the door, expenses going out the door is somewhat unique. And so we have to be able to understand that. And so constantly evolving that, constantly thinking about how to understand capacity, encouraging lenders to adopt tools that allow us to expedite the learning loop. I don't think it's that far away. I mean, I think it'll happen in our lifetimes that we'll get there, but it's going to take everybody being willing to lean in.
So let's pivot for a little bit. Let's talk about diversity in the industry, which is something that I think is very important. You know, one of the things that I got asked by CNBC recently as to why has it been so difficult to create diversity in the mortgage banking and real estate industry. And my answer, I don't know if it was the right one, but what I said is, it's a very unique industry in this context. If you ask 100 people in the real estate or in the mortgage industry how they got into that business, you'll probably hear 100 different answers, but the one answer you won't hear is that it's what I studied in college and what I always wanted to do. Generally, we got into the business because somebody invited us into the business, introduced us to it. So it's a business that sort of is a self-selecting kind of business. So it's difficult sometimes to break those cycles. But I do think it's important. And one of the objectives that I have, and I don't mean to pontificate here too much, Michael, I have a tendency to do that, is that in these cycles, these down cycles, right, we tend to see a lot of consolidation in the industry. So companies merge, some companies go out of business, there's a lot of consolidation, a lot of changes in the industry. But we also see coming out of that, new companies tend to emerge.
Yes.
So a lot of these companies that either went out of business or merged or whatnot, a lot of those people who are leading those companies will go out and start their own mortgage banking firms or mortgage business companies. I would like to see the next cycle a much larger percentage of those companies being led by Latino and black and brown type mortgage banking leaders. I do. And not just for, selfish reasons, because I want to see that happen for the benefit of them, but I honestly think that the process of qualifying for a mortgage is still challenging. That whole process is intimidating. So to have somebody who is from your culture, who can speak your language, who understands those cultural nuances is a tremendous benefit. So I don't know if you guys talk about it much in Freddie Mac, but I imagine that you do to some degree. How do we get more diversity in the industry? And I do want to, after this conference, connect with you again and talk a little bit about that in particular.
I think it's great. And I think when you look at the momentum in this market and the size and scale of this market, I think you all should think of yourselves as the acquirers, not the acquirees, right? I think you're in the people in this room and the people outside this room are in the position to accelerate that pace. We talk a lot about diversity at Freddie Mac, a whole lot, and we're constantly searching for talent to join our firm who can make a contribution. And at Freddie Mac, our business is a little unique in the sense that we're not in the primary lending community. We buy loans from the primary market, we guarantee them and sell them to investors, and we manage a lot of risk in that process. We manage credit risk and interest rate risk and operational risk and cyber risk and all kinds of things in that regard. And so, we need to develop people who can think and operate at scale in those spaces, and you're all very capable of that if that's what you want to do. We recruit, this year we had 180 interns at Freddie Mac over the summer. And since I've been there, we've done three summers in a row. And we were doing it before that, but we've grown it. And I think we'll continue to grow it. But you know what? There's not enough diversity in that pool. And so we are searching to find students at universities and colleges around the country. We're partnering HBCUs. We're partnering with other colleges and universities who have diverse representation. We're out searching for the talent to get them into the firm, to teach them the business. If they stay for a career, great. If they stay for 2 to 5 years and go out and start their own company, great. We're happy for all of that. And I think your point is right. Somebody invited us into the business, and I would add to that. And I would say, and then they mentored us. Right? Like I can sit here and think of the 3 most influential mentors in my career, and I'm sure you can too, right? And so how do you find those people, mentor them, reach a hand out, help the next one up, and let them go zooming by you? Because I think that's what we have to be willing to do.
Yeah, and I think we all have a stake in this.
No question.
And one of the things that, I always make a point of saying, because obviously I'm a big advocate for Latino home ownership and Latinos in this industry, but it's not just for the benefit of Latinos, right? Our industry, our economy is dependent on the Latino population thriving, purchasing homes, owning businesses, investing, building wealth. The prosperity of the United States is really dependent on how well the Latino community does economically.
Well, it's a really big demographic, right? And it skews young.
Yep.
And so we know that. And so if you think about that, you have the advantage of time ahead of you. And that might not sound like an advantage, but it is an enormous advantage when it comes to home ownership and investing and all of the other starting businesses and maybe starting more than one business. But time is an enormous advantage when you're on that side of it.
I would be remiss if I didn't ask you, as somebody who I think probably mentors a lot of people, and I know a lot of people personally who owe their careers to you, but what advice do you have for the Latino professional community in the mortgage banking and real estate industries?
I think first and foremost, follow your passion. Figure out what gets you up in the morning, what you're most interested in, and invest in it, get committed to it, put your very best effort into it and see what happens. So start there. Like, what is it that motivates me? I always had a passion for housing. I was raised by a family who came out, who lived through the Depression, and housing, owning a home was a huge deal to my parents and grandparents. And when I got out of college, my first question my grandmother asked me was, when are you going to buy a home? Okay? And this is an Italian woman who lived through the Depression, right? And so I became very interested in that. So find what you're interested in, find what you're passionate about, and commit your time to that. Secondly, surround yourself with people you can learn from. Be a lifelong learner. Commit to never being as good as you think, always aspiring to learn more. Never stop learning, I think is a huge thing. And then the last one is look for places where you can make a contribution. How can I contribute? So for what it's worth, if somebody asked me, how did you make the career choices you made? I looked for places, did I think I could learn something? Did I think I could contribute something? If I thought I could contribute and I thought I could learn, the reward will take care of itself. Because if you're willing to work hard and put forth the energy and you're passionate about it, the rewards will come, the opportunities will come, and you almost don't have to worry about that. It's a function of, are you learning? Are you contributing? And when you feel like, I'm not learning anymore, go find the next thing to learn. Go find the next space to learn. Go find a new group of people to learn from. I think that's the best way I could describe it.
That's great advice. You know, we in the real estate business talk a lot about surrounding ourselves with people who we aspire to be like, right? So if you surround yourself with people who are successful, you're much more likely to be successful. One of the things that I like to say is that successful people are busy people, right? So they're not just going to hang with you unless you bring something to the table.
Right.
So be great at something first, right? Learn your craft. Be outstanding at it. Perfect something, and that'll open doors for you. You'll be invited to those circles. I mean, I love to talk about that a little bit. So
maybe
please.
one more, which is think beyond the transaction. I think in our business, in the real estate mortgage business, it's easy to get caught up in the transaction, this transaction, that transaction, the next transaction. Be a student of the market. Be a student of the marketplace, of the market participants, of all the actors involved, and have the broadest lens you can have, right? If you can develop that broader lens and then apply it at the transactional level, sort of the ability to zoom in and zoom out, I think that serves people well.
Yeah, that's great. You know, I'll just piggyback on that one more thing, and that is, I've always believed that success is a factor of what you know, but also who you know.
Yep.
And events like this actually have both.
Yes.
You have the capacity to learn a lot of information that could be useful in your businesses, but you never know where the person sitting next to you is going to be in the next 5 years. Trust me. I love to brag about this one thing. I actually played college basketball a lot of years ago. My head basketball coach at a Division III school was a kind of a hard-driving, very disciplinary type coach that I had a hard time playing for. And, you know, 10 years later, he ends up being in the NBA. Today, he is the winningest coach in the history of the NBA, Greg Popovich. And I look back and say, I should have listened to him more. I actually had the chance to talk to him last year, and I said, had I known you were the GOAT, I would have paid more attention to you. But my lesson in saying that is that you don't know what the person sitting next to you is going to be doing in the next 5 or 10 years. So take care of those relationships, value them. Someday, you're going to be Michael and I's age, and our relationships are our currency today. The people we know and the people who respect us and the people we can call on is what gives us our value. And I can't advise all of you enough in that regard.
If you're building relationships, if you're learning in your community, and I'm going to add one more, if you're a teacher in your community, be a teacher in your community. You know, at Freddie Mac, we just relaunched our Credit Smart education program in Spanish, okay? And so take advantage of that. Take that into your marketplace. Learn from it. Like this is just another example of continuous learning, right? How do we take this into the marketplace? Be the source of teaching families about how to be good stewards of money. Not just how to buy the next house, but how to manage their finances, how to live their life in a successful financial way. That's a huge benefit that will grow over time. You'll have people walking up to you 30 years from now saying, you know, I remember when you taught me how to do this, and I've applied those lessons, and look what it's done for me. It happens without you even thinking about it. Find a way to be a teacher, find a way to be a learner.
It is, what you just described is actually the foundation of the Hispanic Wealth Project.
Right.
And we put some disciplines out there around investing and managing your money and being frugal and all those things. But the theory behind it is that these people here in the audience are influencers in their community. And if the influencer community adopts principles, disciplines, that'll cascade into the general marketplace faster than anything else. And that's why I think we've been successful to date.
I completely agree with you. You all are in a position of trust. You connect with the community because you're from that community, and you're in a position to be that trusted advisor. Use the tools that are available to you. Take full advantage of the opportunity to be that trusted advisor. Bring that to the table, and your business will grow.
All right, Michael, thank you so much for being here this morning.
It's a privilege.
Great to have you. By the way, Michael just had a recent made a recent announcement. He will be retiring early next year. So thank you so much for your contributions to our industry. And to your friendship to our organization in particular. Thank you, brother.
It's my pleasure. Thanks.
Thanks, guys.